Welcome in this video. How will the Fed's announcements affect XCN? We will analyze it. Don't forget to subscribe, like, and please watch till the end to understand. When we take a closer look at the price action, we can see that a critical support level was previously broken to the downside, but the price has since moved back above that level. This is quite significant from a technical analysis perspective because even though the support level was breached, the price reclaiming it afterward often indicates a false breakout. These types of false breakouts tend to mislead most market participants and allow larger players to trigger stop orders and collect liquidity. Once this occurs, the price often sharply reverses direction, retests the broken level, and then establishes a new trend. Currently, the price has returned above this previously broken support level. Such recoveries are considered highly positive developments in technical analysis, as they show that the market is beginning to recognize that level as support once again. A pullback to this level followed by a bounce back upward typically signals a classic retest move. In technical analysis, a retest is regarded as a reliable pattern, where the price breaks through a level, returns to test it, and then continues in the same direction. If the price continues to hold above this support level and does not experience heavy selling pressure during the retest, the likelihood of an upward bounce increases significantly. This suggests that the market is now treating this level as a solid foundation and may be preparing for an upward move. Additionally, a positive reaction from this level could indicate that the previous downtrend has ended and a new uptrend may be beginning. Therefore, such movements are of great importance in technical analysis and can offer strong buying opportunities for investors. This kind of setup is also crucial from a market psychology standpoint. Support levels are often seen as confidence points by investors. As prices rebound from these levels, confidence among market participants grows, and with that growing confidence, buying activity tends to increase. If this is accompanied by a rise in volume, it further suggests that buyers are entering the market strongly, which helps solidify the foundation for an upward trend. In conclusion, the price reclaiming this important level can be interpreted as a very positive technical development. If a retest of this level occurs and the price reacts to the upside without dropping below it, it could signal a stronger and more sustained rally in the days ahead. Patterns like this generate reliable signals in technical analysis and offer valuable insights into the potential future direction of price action. But of course, we can't rely on support alone for analysis. Let's take a look at other metrics as well. Stay tuned. When analyzing the chart, a highly notable technical formation becomes apparent: the falling wedge pattern. This structure indicates that the price has been moving within a narrowing channel of lower highs and lower lows over a certain period of time. However, the unique characteristic of the falling wedge is that, although the price appears to be in a downward trend, the pattern itself is considered a bullish reversal signal. In other words, while this formation may initially look negative, it is actually a reversal pattern and often results in a strong upward breakout. The key aspect of a falling wedge is that the price compresses into a tighter range over time. The upper trend line, or resistance line, is downward sloping, as is the lower support line, but the two lines converge to form a wedge. This indicates that selling pressure is gradually decreasing and that sellers are no longer as dominant. The price squeezing into such a narrow range often signals an imminent breakout. Such contraction typically leads to an explosive move, usually in the opposite direction of the pattern, upward. Certain conditions must be met for the pattern to be valid. The price should touch both the upper and lower boundaries of the wedge multiple times, creating a series of oscillations within the pattern. Volume is also a crucial element. Typically, volume decreases as the price progresses within the wedge and then surges at the breakout point. This increase in volume confirms that the breakout is healthy and reliable. The current structure observed on the chart appears to meet these characteristics. The price continues to move within the wedge, suggesting a potential breakout may be near. If the price successfully breaks out upward from the wedge, the move is usually quick and strong. This is because such patterns signal the end of a prolonged period of downward pressure and the beginning of renewed buyer control. In this context, the falling wedge can present a valuable opportunity for investors. These breakouts not only provide strong technical signals, but also tend to have a positive impact on market sentiment. Many investors view such breakouts as potential turning points, which can add extra momentum to the move. Especially if the price breaks above previous resistance levels with increased volume, it confirms the sustainability of the upward trend. Furthermore, these types of formations can often signal a larger move. Falling wedges sometimes emerge after long periods of consolidation, and the breakouts that follow can be sharp enough to quickly recover previous losses. Therefore, falling wedge patterns are considered highly valuable tools in technical analysis. In conclusion, the falling wedge pattern observed on the chart could signal a potential upward breakout. If the pattern breaks to the upside as expected, this would be a positive signal for the market and could increase the likelihood of the price entering a new upward trend. It is crucial for investors to closely monitor such technical formations, particularly watching for volume and momentum increases at the time of the breakout. If assessed at the right time and in the right way, these formations can offer highly profitable trading opportunities. And you may wait for the breakout as a confirmation to enter the trade. When analyzing the RSI indicator, a particularly noteworthy and historically reliable support zone stands out. Specifically, the area highlighted with a green box at the lower part of the chart can technically be referred to as a reaction zone. This area represents a level where the RSI has frequently found support in the past and subsequently bounced upward. In other words, every time RSI has approached this zone, it has marked points where buyers re-entered the market and the price recovered, at least temporarily. Therefore, this zone is not randomly drawn. On the contrary, it is a statistically meaningful base that has been tested and validated through historical data. Such reaction zones are especially important for traders who rely on technical analysis. In momentum-based indicators like the RSI, responses from specific levels reflect investor psychology and market buying-selling behavior. The green box seen here often aligns near the 30 level on the RSI scale. This level is considered an oversold region in RSI terms and typically corresponds to areas where price momentum slows down or reverses upward. However, the highlighted zone is not just a theoretical oversold level. It is a technically significant signal area backed by historical performance and reliability. Another factor that increases the importance of this zone is the RSI's consistent upward response when reaching these levels. This suggests that the area is not only a historical support, but also a psychological threshold that could remain effective in the future. Many market participants base their positioning on RSI readings reaching certain levels, which creates actual effects on price movements. Therefore, such reaction boxes are extremely valuable for predicting how far prices might fall and identifying potential reversal points. At the moment, the RSI is once again approaching this critical level defined by the green box. If the previous behavioral pattern repeats, the RSI may bounce from this zone and begin another upward movement. This would also imply a price increase on the chart, as upward breaks in the RSI often coincide with similar price reactions. Particularly strong reactions from such areas can lead to sharp and high-volume upward moves in the price action. In light of all this data, it can be said that the green box on the RSI represents a critical decision area in technical analysis. Whether this zone holds or becomes active again could play a significant role in determining short-term direction and the continuation of the current trend. If the RSI begins to rebound from this zone, it may not only signal a reactive bounce, but also indicate that the market is regaining strength. In conclusion, this green reaction box on the RSI may serve as a potential roadmap not only for the past, but also for the future. A move into this zone followed by an upward reversal could indicate a renewed recovery trend in prices. Therefore, investors should closely monitor how the RSI reacts to these technical support zones and shape their strategies accordingly. Oscillators like the RSI not only show momentum, but also reflect the emotional tendencies of market participants. For this reason, such indicator levels should not be overlooked, but instead be strategically evaluated. Yes, friends, I hope you liked the video. If you subscribe to my channel and like the video, more videos will be coming. Be careful in your investments, analyze the risks correctly, and always take strategic steps. I will be with you with different analyses, investment opportunities, and technical information in my videos. I wish you all a lot of profit. See you soon.